All right, the Naira has strengthened over the current week on the end window where, we're just coming back from a break. During the Christmas breaks, there was little supply, so we had seen a bit of depreciation in the Naira. But this week, once market fully started trading, we've seen Naira appreciate. We've seen it strengthen from a 366 position to a 364.50 before close of today. This is a big improvement from going into the Christmas hauls where supply was very little and demand continued to outpace. But right now we've seen the flip side of that with more supply than demand in the market, causing the appreciation in rates.
But yes, there's ample supply now, but how would you describe demand now versus what we saw last year, especially towards the end of last year where we saw that significant pressure from the demand side? Would you say that there's still demand, only that now the CBN is able to put more dollars into the market?
Yeah, I would say that yes, there's still demand right now, but it's not necessarily the CBN putting more dollars in the market. We've seen a bit of foreign inflows into the market as they've expressed interest, especially with the yields being this high. So we've seen a renewed interest in the Nigerian fixed income space with foreign portfolio investors coming in.
So for the new week, what trading band would you expect to see the Naira trading if it's trading to somewhere around 363, 364 at the new window? At the parallel market today, I was just looking at it just before I came on, it was 363 Naira to the dollar. But what trading range should we expect to see it in the new week?
In the new week, I'm seeing a 362 to 364 levels. If the Naira continues to strengthen in this at the pace it did in this current week, another 2 Naira drop or 2 Naira strength on the Naira would actually be in place because, as you can see, supplies are outpacing the demand.
Okay, let's switch over now to the Treasury bills market. We did see that bearish trading for most part of the week with many traders selling down their positions to raise liquidity. But we're still seeing the CBN, of course, mopping up liquidity at the market. And I think we did have a maturity also this week. Just bring us up to speed in terms of how the market performed this week, how investors played the market and the rates that we saw.
In the T-bills market, we still see the bearish sentiments playing out. Participants are trying to sell down their position to raise liquidity, and the CBN still continues with its tightening stance, really mopping up liquidity. Even with the huge maturity that happened on Thursday, the CBN mopped it up almost immediately. Right now, system has been in a debit with rates around 25% on the overnight.
But how would you describe liquidity? Just generally, liquidity levels this week, how we started the week and where we are right now with liquidity? It started
a bit, system was a bit liquid at the beginning of the week, but with the constant mop, almost from CBN and also with the mops, with the special almost, we've seen liquidity thin out and dry up.
Should we expect to see some more aggressive OMO mop-ups next week in the new week? And because I'm looking at, effective yields as high as 17%. Is that what we can expect in the new week?
Yes, I expect CBN will continue with this tightening stance in the coming week, and we may just see it just up until elections. Okay, but
talk to us about, still on the bond market, we did see bearish trading also on that end. How do you see investors, especially the fund managers, pension fund managers, how they're going to play the bond market next week?
Well, on the bond market, we are still yet to see a calendar. So right now it's a bit bearish with few speculative trades going on there. People are just waiting to see, okay, the calendar come out before a position is taken. So it's been a bit of quiet trading in the past week.
What is your forecast for trading in the first quarter of this year? We talked a lot last year about that aggressive mop-ups that we saw in December and the fact that obviously the domestic market is still dominated by government borrowing. But just talk us through your forecast for Q1.
In the Q1, we expect the rates will still remain high and very attractive as it currently is right now, with effective yields around 17%, and we expect this will continue throughout the Q1. But going on after elections, we expect maybe rates will drop a bit because the reason for the tightening wouldn't be there again. But as it is right now, we see rates will continue on this high pace, and market will remain stable around this current rates up until the end of Q1.
All right, Deinma.